Good day. My name is Marcus Noland. I'm the Executive Vice President and Director of Studies at the Peterson Institute for International Economics. And I would like to welcome you to the Peterson CF40 Forum on China's Economic Outlook and the Future of Digital Currency. This is a time of considerable tension in U.S. China relations. And while it's always good to speak to counterparts, it is at times like these that such engagements are especially important. In that regard, the repeated aspect of the PIIE CF40 meetings is invaluable, insofar as repeated exposure can contribute to understanding and trust, and is particularly helpful at times like these. So I'm genuinely pleased and honored to make these opening remarks. We have a very impressive set of speakers on the agenda and an agenda of great importance, and I would like to thank Huang Haiming and Tianli Huang for putting this all together. We have one amendment to the program. Unfortunately, Dr. Yu Yongding has fallen ill. I've been told that it is not life-threatening, which is a good thing, but Dr. Yu will be unable to participate this morning. Dr. Miao Yang Liang, who was originally slated to moderate the first panel, will speak in Dr. Yu's stead, and Huang Yiping has graciously agreed to take Dr. Miao's spot as moderator. In terms of stage management, the speakers should present from the podium first, and then they will all join together on stage for a question-answer period. So without any further ado, I would like to turn things over to Dr. Huang Yiping to launch the first panel.
Thank you, Marcus, for the initial remarks. And I also want to thank PIIE for jointly hosting this event together with CF40. The first session will focus on two big issues, related issues. Number one is China's economic outlook, and number two is Sino-US economic relations. We have four very distinguished speakers for the session. Gao Sanwen, Chief Economist of a security company in China, but he is also a member of the CF40 Academic Committee. Dr. Miao Yanliang just mentioned that he is also a CF40 member, but also Chief Strategist at CICC, also an investment bank in China. And then we have two senior colleagues from PIIE, Nicholas Ladi, also a senior fellow at the Peterson, but also vice chair of National Committee of U.S. China Relations, and Chet Bong, also a senior fellow at PIIE. So without taking further time, I'd like to invite the speakers to come onto the stage to present one after another. The agenda says, I think, 15 minutes each. I would suggest, if it's possible, if you take around 10 minutes, then we'll leave a bit more time to discuss. So let's welcome Dr. Gao Sanwen to the stage.
Good morning, everyone. It's my honor to be here again after 3 years of pandemic to share some brief observations regarding China's economy now. Actually, I'd like to share two key observations regarding China's economy. One is concerning the property market. The other is concerning the role of private sector in fixed asset investment. As for the property market, my information is that even though the property market is recovering a little bit, however, private developers are still deep in the water and in big trouble. I'd like to share some data here. Here is a bond market index, and the blue line is a so-called real estate investment grade bond market index, and the red line is that of the high yield bond market index. And the starting point is January 2021. We know that the crackdown began on July of 2021. And we can see that from that on, the bond market index dropped dramatically. And even though since the last quarter of 2022, it recovered a little bit. However, the red line is far below the level we observed in July 2021, and so is the case for the blue line. And we can also check the development of on the stock market. And here, the red line is the stock market index of the public developers, public property developers, SOE, property developers. And for the blue line it's the private developer stock prices indexes. And we can see ever since July 2021, for the red line, for the SOE property developer index, it's basically stable. It's basically stable, given that the overall market index dropped actually quite dramatically, more than 20%. So its performance is quite good. However, for private developer stock market indexes, its drop is very big, more than 50%. Particularly compared to the performance of the public sector, the divergence is quite great, and the divergence began since July 2021. And we can also distinguish between the so-called high-graded private developers and the low-graded private developers. And we can see that no significant difference existed between those two groups, suggesting that the discrimination or crackdown or pressure between public and private developers are systemic, and no significant difference between private developers itself. And here is from the viewpoint of domestic bond market, we can see that the fundraising for the private developers is basically close to zero. However, for public developers, it's still more or less normal. And here is from the viewpoint of land purchase by private developers, we can see that until last month, the land purchase by private developers is basically close to zero, suggesting ongoing cash flow pressure. And here is the data about the residential housing sales and also the new construction of residential housing. We can see that a big gap existed between those sales, those number of sales, and also the figure of new construction, which also suggested that bigger cash flow pressure is present, particularly for private developers who dominate the property market. So overall speaking, the information is like this. Even though the sales volume is recovering, however, for private developers, the cash flow pressure is still very huge. And we expect that ultimately in 1 to 2 years or a little bit longer, many of them, if not all of them, or most of them, many of them will be ultimately wiped out. And then the market will finish the restructuring process to start a new phase. My second observation is concerning the role of private sector in fixed asset investment. As it's quite clear here that ever since 2015, the share of private sector fixed asset investment has been declining ever since 2015. However, the picture is quite complicated if we distinguish the data into manufacturing sector and the service sector. We can see that the fall mainly concentrates in service sector, and the share of private sector for manufacturing sector actually continues to go up and reached a historical high last year. So the crackdown, the pressure for private sector mainly concentrates in service sector, as we all know, for platform, for education, and for medical and some other sub service sectors. But for manufacturer sectors, overall speaking, the role of private sector is still quite active, and the government policy is still encouraging, or at least quite tolerant. And as a result, we can see that China's share as of the world export market is still climbing up, and it reached the bottom around 2017 or 2018, and continue to go up even in 2019, just before the pandemic, and reached a new high last year. That's all. Thank you.
Thank you very much. Dr. Gao shared with us a dichotomy situation of the property development, especially the public developer versus the private developer. So looks like we still have lots of job to do to improve the situation, especially in the private sector, including the second part of the story he shared. Thanks again. Let's welcome Dr. Miao Yanliang.
I want to begin by saying I'm very pleased to be here. Actually, I was here only less than 2 months ago at a conference, Floating Exchange Rate 50. As Professor Huang mentioned, I'm supposed to be the moderator of this session. Now instead, I'm going to give a remarks. I don't have a prepared PPT. I want to maybe share with you my own reading of, the ongoing recovery in China. Dr. Gao mentioned, I think, 2 things very important to gauge the long-term prospect of Chinese recovery. That is what's happening in the real estate sector, and then what's happening on the manufacturing or the export competitiveness. Maybe I want to bring your attention a little bit back to what's happening now, what's happening on the ground. My first point would be, we have a recovery. The recovery probably will be, depends on where you see it. I mean, probably stronger than previously expected. The government has an objective of 5%. I think most investment banks, the sales side, put the number now at 6%, around 6%. So I think that's the general mood here. We see a recovery, but then the question with that is, the recovery is a bit uneven and untypical. Untypical in the sense that, we have 3 years of COVID and pandemic. Now we had a opening up. So there's a lot of pent-up demand in services. That's very untypical from the past recoveries. It's also maybe, in the post-recovery, people think, when Chinese economy is doing well, it has huge spillover effect on globally on many commodity markets. But this time is maybe slightly different because it's mostly driven by services, so it's untypical. But it's also uneven in the sense that services is doing better than production. Our latest PMI print, April PMI just came out. Service PMI still doing very well, 56.4, and yet the manufacturing PMI dipped slightly below 50. It's now 49.2. This just shows you, this is a very untypical and uneven recovery. Now, the question is that, many people or investors coming to me saying, how should we gauge this sustainability of Chinese recovery going forward? That we have to keep in mind two things. One is the 3-year COVID scarring effect. If we look at the trend line growth compared to what happened, trend line income to what's the real income, we are talking about around a 10 percentage point drop in both of GDP trend line, also both of income level. Think about it. 2020 was growing at 2.3%. 2021, because of the rebound, 8.4%. And 2022, Chinese economy grew at 3%. And then if you think about the trend line between 5 to 6%, and then we have a shortfall, anywhere between 8 to 10%. That's the output gap we're talking about. So taking into account that output gap, we see some recovery is just very natural. And then also because of that falling output, we see consumers' balance sheet have been hurt. Some of the small enterprises' balance sheet have been hurt. If you look at the survey data, consumer confidence at 30. 20 years ago, that data is at 60 or 70. 10 years ago, consumer confidence data is 50 or above. So 30 is relatively low level. And then the mirror image of lower consumer confidence is they've been much more cautious. The savings propensity has been aging up during the past 3 years. So that, I think, is the broad backdrop we have to take into account, gauging the sustainability and the strength of ongoing recovery. Now, the question is what to look at, what are the indicators we should pay attention. Here, I differentiate between short-term, medium-term, and the longer term. Short-term, I think, we can just look at the high-frequency M2, total social financing. The broad money March data is 12.7%. That's a very high number. You have to think about, the Q1 GDP grew at 4.5%. You add like between 1 to 1.5% deflator, that's like a 6% nominal growth. So that gives you a gap of more than 6%. So we have a lot of money sloshing around. And then those money will be either come to the real economy. If it don't come to the real economy, they go to somewhere. So I think in the short term, we are actually confident, the recovery is there. But the question is on medium term. Medium term, we look at consumption, consumer confidence. The retail sales number in March came at 10.6%. Overall, it seems to be a good number. But if you look down to the different components, you see that consumer discretionaries didn't do well. What did well was the staples that you have to buy on a daily basis. That's also linked to the previous theme I mentioned, that consumers' confidence is not back yet. And then critically, I think on the medium term, as Dr. Gao mentioned, we have to pay attention on the real estate. That's the traditional driver of Chinese growth. The good news from March data, latest data, is that the sales has been back. Finally, we had a positive sales, 0.1%. That's the area sold. And then if you look at the revenue, it's even better. The revenue is 8.7%. So bear in mind that I think the sales lead investment. And then if we have sales number continue to improve, we should expect investment improve as well, which is going to give a boost to the GDP. Of course, then here we have a distinction between private sector developers and then the public sector developers. That's something I think we have to continue to watch very carefully. And then another good news on the medium term is export. March export grew more than 14%. I mean, of course, April export pulled down a bit. That's only natural. But overall, I think we shouldn't be too bearish on export outlook. Given what Dr. Gao just showed in the chart, I think the competitiveness is still there. So that's the medium term. And then in the longer term, I think we have to look at a few. We have to find some indicators to gauge about the private sector confidence. Ideally, if we can get this virtuous cycle going, we had the fiscal and the monetary stimulus that's shown up in the broad money growth, shown up in the TSF, total social financing data. And then medium term, if the government stimulus kicks the consumer spending, kicks the consumer confidence, we're going to have retail sales going up. We're going to have a turnaround in real estate sales. And then now comes the key question, will the investor be back? Will the private sector start investing? That's one thing I think we have to look very carefully. And another thing is the young people unemployment. The latest data, the March is at 19.6%. That's still at an elevated level. It shows that the challenge in the economy is facing. With all this said, I want to leave you maybe a still longer term or challenge or question facing the economy. We had a scarring effect. We had an ongoing recovery. At the same time, I think we also had structural changes. These structural changes, mainly in two areas. One is the traditional sectors like the real estate sector is no longer the main driver to stimulate or for economic growth. But we have the new sector, which is the digital economy. That's including the electric vehicles, the batteries, and solar panels, etc. So that's, I think, something we have to bear in mind. Maybe the economy is just fundamentally different from we're seeing 5 years ago or 10 years ago. So that's one thing I think the structural transformation. I want to conclude by saying that yes, we are in uncharted waters. 3 years of COVID, we see a recovery. I still weak and uneven, untypical, but I think we should be hopeful that with enough policy stimulus and with enough export and the real estate sector turning around, we're going to see a continued improvement in business sentiment. I will leave as that. Thank you for having me.
Thank you. Yan Liang gave us a story about what he called the uneven and untypical economic recovery, partly because of the scarring effect. But the last point he made about growth sustainability, which really, according to him, is dependent on structural change. And I think that's a very important point, and that's a very important issue for us all to watch. And now let's turn to our PIIE colleagues. Nick first. Welcome.
I'm very happy to join the discussion today with CF40. We've had a lot of programs together over the years, and I hope they will continue. I'm going to focus mostly on the longer term, and I'm going to start with the first diagram. I'm not sure I'm controlling this or someone behind the scenes. Yeah, here's the first diagram. The key question in this diagram, I think the most interesting question about the Chinese economy is not whether growth is going to be 5% this year or 6% this year, but what's the long-term growth potential. And this diagram is showing you that there's been a big step down in China's economic growth since around 2012. And so the key question is this step down, this sharp decline, a function of structural, more permanent factors, perhaps declining returns on investment, a slowing and then reversing of the growth of the labor force, or some other structural factors, or are cyclical factors driving this? In the 3 years of the pandemic, for example, the growth was well below the 6.2%, something on the order of 4.5%. So I want to focus on structural versus cyclical. And one of the questions I think that's related to this, and we've already seen some slides on this, is what's been happening to the growth of private investment as opposed to state investment. And certainly the private sector deserves to have a greater role in any analysis of the Chinese economy. If you look from the early 80s onward, private investment grew very rapidly relative to state investment. In many years, the private investment was growing more than twice that of state investment. So the share of investment undertaken by state firms fell from about 82% of all investment in the very beginning of reforms in the 1980s, and then it fell to about 34% by 2012. The share of investment by private firms rose quite substantially, as we saw in the earlier diagram. My numbers are a little bit different, but the story is basically the same. But starting in 2012, as you can see from this diagram, the gap between the growth rates began to shrink. And after 2015, state investment was generally well above that of private investment. And this gap reached an all-time high last year when private investment was only growing at about 1/10 the pace of state investment. Now, because the returns on private investment are substantially higher than those earned by state firms, I think the decline in private investment accounts for part of the slowdown of China's growth over the last decade. How much? I don't have a precise estimate. I tend to, always want to ask the question, is this a result of structural factors or cyclical factors? I think we'll have to wait and see which it is. I tend to think it's potentially cyclical, and changes in government policy could moderate the trend that we've seen in recent years. So looking ahead, I want to take you through the IMF most recent Article 4, in which they have a baseline scenario in which China's growth is about 3.3%. And then they have a reform scenario in which the growth would average about 4.5%. Obviously, that would make a big difference over a 15-year period. The economy would be roughly 20% bigger by 2037 as compared to the baseline scenario. I won't go through all of the elements of the reform scenario, but I'll just mention the elements that are in their reform scenario. First is expanded programs of social protection, which they believe would raise private consumption, reduce precautionary saving, and would trigger an expansion of the service sector, and also would put China on a less energy-intensive growth path. So that's number one. Number two is reforms that would help to close the productivity gap between state and private firms. The third is more general pro-market reforms that would increase business dynamism. The fourth is labor market reforms that would gradually raise the retirement age to 65. And the final element is educational reforms that would improve access to and improve the quality of education, thus boosting the stock of human capital. Now, the fund assumes that each of these reforms would be kind of linearly implemented over a 15-year period. So when you look at the details of their analysis, the gains of growth in the early years would be smaller than the 3.3% and somewhat larger in the later years. Now, in my opinion, the reform scenario is not very bold. Number one, there are no specifics mentioned about restoring the confidence of private entrepreneurs. And as we've seen in the earlier presentation, as well as in my diagram, private investment has basically collapsed in the last year or year and a half. Second element, which I think shows that it's not very bold, is a 15-year phase-in for some of these reforms seems rather, I'm not quite sure what the right word is, it's not very ambitious. To raise the retirement age to 65 is probably something that should be done over a much, much shorter period of time. And finally, there's insufficient recognition of the potential contribution of more stringent reforms of the state sector, state-owned enterprises. I think we need to keep in mind that state-owned enterprises at the end of 2021, which is the most recent data available, control more than 300 trillion in assets. Now, these are enterprises, firms that are operating in a market-oriented environment. This does not count assets of state agencies or what the Chinese call 事业单位, things like schools and hospitals and other things like that are not counted. These 300 trillion is just the assets of enterprises. If you don't remember off the top of your head what China's GDP was in 2021, it was about 114 trillion. So these assets are more than 2.5 times GDP, and the returns on these assets lag well behind those of private firms, and they continue to fall. Over the last 10 years, return on assets of state companies has actually declined by a quarter. It's gone from 4% to 3%. So I think there's a lot of potential for raising China's growth well beyond the reform scenario that's shown by the IMF, but it will take a more aggressive reform program. Thank you.
Thanks, Nick. Nick highlights the importance of reforms for supporting a sustained growth of the Chinese economy going forward. And I think all three previous speakers had a very important message in their presentations. That is, we need to focus on the important roles of the private sector, whether it's in investment, in growth, in efficiency, and so on. So I think that's something probably we can think about, it's especially when we look for further policy reforms. Next, let's welcome Chad to talk about the U.S. China trade relations. Welcome.
Thank you for the kind introduction and for the invitation to join you. It's so great to see people in person again. Okay, I'm the trade nerd, so we're going to switch gears a little bit and not talk about the Chinese economic outlook, but look very much at the bilateral U.S.-China trade relationship and what's been happening with a deep dive into some of the micro data. And so what I'm going to do is to basically look at two things, both sides of the coin, essentially. U.S. exports to China and U.S. imports from China, to try to tell the story that essentially, despite the fact that last year, so in 2022, bilateral trade in both directions was higher than ever, yet there's still evidence when we look deeply at the data that there is some of this de-risking, I guess we're going to call it now, or decoupling, or changes, major changes of trade behavior taking place. So let's start first by looking at U.S. exports to China. And again, we're now almost at the 5-year mark of the beginning of the trade war, right? So the first round of tariffs went on in July of 2018. So we're now almost 5 years beyond that. If you remember, there was 18 months or so of tariff escalation, and then in January of 2020, we had the Phase 1 agreement, where China agreed in principle to purchase an additional $200 billion of U.S. goods and services above the 2017 baseline level. So this chart we were putting together monthly in the period of 2020 and 2021 to kind of keep everybody honest about how much was actually getting purchased. By the end of that 2-year period, when we added it up, it turns out that China had purchased exactly none of the additional $200 billion that was promised in that agreement. They hadn't even gotten back to 2017 levels. What we plot here, and so the red line is sort of the commitment, if they had reached those commitments where we would have ended up. The black line is the actual trade flow. The orange line is to imagine a world without a trade war, without a phase one agreement, in which US exports to China had just grown at the rate of China's imports from the world over that same time period. No more, no less, right? Just sort of the average. But you can see when you then look at last year what happened, right? US exports to China still not doing all that well. Yes, higher than ever, technically, but still really, really below what they would have been but for this trade war period. When we break it down, so in that phase one agreement, it's actually a useful exercise because it breaks US exports to China up into manageable chunks that you can analyze and understand where things are coming from. The biggest part of US exports to China before the trade war was in manufacturing. Those were hurt by the trade war and have not come back at all. During the 2020 to 2021 period, products that did reasonably well were things like semiconductors, semiconductor manufacturing equipment, COVID-19 products, so a lot of medical supplies, things like that, because these were the things that were in high demand during the pandemic period, right? When everybody needed semiconductors to be able to create the laptops and iPads to be able to work from home, school from home, video games to be able to entertain your kids from home, all that kind of stuff. Huge booming demand for semiconductors. US exports of those things boomed. But then when that demand began to fall off last year, those have now come back down to earth as well, and with the export controls and new policy taking place alongside it. Other products that were huge, big US exports before the trade war, aircraft, Boeing, fell off, have never come back. Some of this has nothing to do with trade war, right? Some of this is the crashes of the 737 MAX, grounding of the model. But finally last year, China did announce they were going to be beginning to buy aircraft again, in particular from Airbus, but no, at least through the most recent data that we had looked at, announcements when it came to Boeing. Autos were huge US exports to China, so think Tesla, but also some of the European models of luxury cars that were being built in South Carolina, exported to China. Those were hurt by the trade war, never came back. So not a good story in the manufacturing side. Energy was sort of the one bright spot over the 2 years of the phase one agreement, 2020, 2021. Again, these are all carbon intensive products, right? So over the long run, not clear how much growth potential there is here. But these actually did relatively well 2 years ago, but then last year fell off dramatically when energy products, the trade in them reoriented in light of the Russia-Ukraine war. So US energy exports tended to all shift themselves toward Europe, the EU and the UK, to help fill in some of the gaps left by Russia's weaponization of natural gas supplies to the continent, the Europeans cutting off oil, things like that. And China instead has said, okay, we're not buying US exports anymore of those products either, so we'll buy more from Russia and the rest of the world. So reorientation of energy trade as well. Services, tourism, business travel, educational exports, US exports, Chinese students coming to the United States to study, all dropped off with the pandemic, with mobility travel restrictions. Not surprising, but those also have not yet come back. So not a good news story on US services export either. The only good news is agriculture, and that has continued to do well. Soybeans, not quite meeting aspirational targets, but still doing extremely well. The one kind of negative to the agriculture story last year was not all these products did well, but even some of the ones that did well in value terms, it really wasn't about increased shipments. So for products like corn and sorghum, even though the values went up, shipments actually fell. This was largely a result of the global boom in commodity prices because of lots of factors, droughts around the world, the Russia-Ukraine war leading to shortages and things like that. So even where you see good news on the agriculture side, it's really a mixed story. The other half of the US imports from China, on the goods alone side in 2022, this is the chart on the left, overall wasn't quite as high as the peak year of 2018, but when you add in services, which are not shown here, it was the highest ever recorded. But when you look at goods, which are most of US imports from China, and you break it down, this is the right-hand side chart, when you break it down by the tariffs, the trade war tariffs that are still in place. Remember, we had this phase one agreement that went into effect in January of 2020, but they didn't get rid of the tariffs, right? So the United States still has tariffs, some of which are at levels of 25% on over $300 billion worth of US imports from China. So what the chart on the right breaks these imports down into is the tariff level that you're currently sitting under, the trade war tariff level. And there's basically three different types. Really high one of 25% and a lower one of 7.5%. And then there were a bunch of products where there were no tariffs whatsoever. Those are the black line where there's been tremendous growth. And so when you wonder why are US imports from China so high, despite the fact that those trade war tariffs remain, it's because there's a third of US imports from China before the trade war that were never hit with tariffs whatsoever. So what were those products? Well, that's where a lot of the growth is, or most of the growth is. Where those products are, these, and it's somewhat, not funny, but an interesting story. Late in the trade war, there was an additional round of tariffs that were scheduled to go on. And President Trump said, we're not going to put the tariffs on these products because we're worried that consumers might notice. Because these are the products that everybody buys for Christmas. And it was coming up on the Christmas season. They were worried about the price hikes showing up. So they delayed them, and then they ended the trade war before these tariffs went on. So what are these products? Well, laptops, monitors, phones, video game, all the stuff for which there was massive consumer demand during the pandemic, right? When everybody was stuck at home, those happen to be the products that we import from China, the United States imports from China, and that were not hit with tariffs during the trade war. So that's where a lot of the boom comes in. So there's absolutely the charts on the right, all the pink area there, not much evidence, no evidence really of decoupling, de-risking, any of that kind of stuff coming out of that data, which makes sense, right? There's no economic incentive really, at least on the policy side, to change sourcing behavior if you're a US importer. But where you can see evidence of decoupling or de-risking or whatever you want to call it, changes of supply chains in the sense of final assembly, the United States importing from different sources, are the products where those 25% tariffs are still in place. Overall imports of those products remain about 25% lower than they were in July of 2018, before right when the trade war hit. These are things like IT hardware, consumer electronics, auto parts, furniture, and of course semiconductors on the import side. And so then you can trace back to what are the new sources of imports for the United States. It depends on the product. For some of this stuff, it might be moving to Mexico, the new place of final assembly. For some of it, it's Vietnam. Right? So there is some evidence of changes in trade patterns, at least where the final assembly of these products are showing up before they come into the US market. And in the last set of products, these are the ones with sort of the intermediate tariffs of only 7.5%. You see some movements there, but it's really a mixed bag. And some of these movements out of China, in terms of where you're sourcing from if you're the United States, were probably happening for reasons having nothing to do with the trade war. So the best example is clothing and footwear. China's getting richer, wages are going up. It's becoming increasingly relatively expensive to do that kind of stuff. It's very labor intensive in China. The industry is moving to places like Bangladesh, Thailand, Indonesia anyway. Maybe the tariffs are accelerating that. And then there's other products where you don't see, despite the 7.5% tariffs, any changes in sourcing outside of China, things like lithium batteries. The United States is still importing a lot of that from China despite those additional tariffs. So overall, trade, US-China trade, still really, really high. But beneath the hood, there's really a lot going on. And so you have to look carefully at the detailed data to really, I think, fully understand the story. Thanks.
Thank you very much, Chet, for offering a very detailed but informative picture about the bilateral trade relations We still have about 40 minutes left for discussion, so why don't we invite the four speakers to come onto the stage? And I will probably try to ask the speakers a couple of questions, and then we'll collect questions, call for questions from the audience. And you see the mic here. When you ask a question, please come to the mic, please. Thanks again. I like to ask a couple of questions of each speakers to start the discussion, and I'll start with Simon on my left. You talked about the current situation of the property sector and the likely evolution of the sector in the coming years. One of the biggest concerns for many people who look at China is that the property sector was very important for contribution to GDP growth in the past. And now this is coming down. What kind of impact do you think this weakening or slowing down of the activities in the property sector would have on the aggregate headline GDP growth in the transitional period or over the longer term, i.e., what kind of contribution or changes of property sector's contribution to GDP growth that you are expecting?
In the short term or in the long term?
Well, I guess in the next couple of years, and then after a couple of years, if you think the situation will stabilize, what kind of rules do we expect from the property sector?
I think the property market is underperforming its long-term trend now because of the trouble in the financial market, because of the ongoing liquidity crunch.
Yeah.
And it may ultimately steadily recover to its long-term trend, possibly 2 to 3 years later. And by that time, I suppose the property investment as a share of GDP may finally stabilize at around 7 to 8%. And now it's certainly much below that level.
Okay. Let me turn to Yan Liang. I mean, if what we expecting in the property sector or the sources of traditional contribution to economic growth in the past is changing, and as you said, we probably have to rely on structure change to see new sources of growth going forward. You briefly mentioned the digital economy, but I guess some people also would ask, mention innovation and so on. If the contribution of the traditional sources declines over time, I guess that's as expected. Where are the new sources of contribution to growth should we expect?
Yes. Oh, thank you. I can, think of at least two areas of tremendous growth. The number one is the new energy or the energy transition sector. That also show up in our exports data. Also show up in Chad's presentation. He mentioned despite 7.5% additional tariff, but the lithium battery export to the U.S. continue to go up. So I think the China National Bureau of Statistics, they have coined a new term called the new three product. That include electric vehicles, lithium batteries, and solar panels. So for Q1 this year, export of these three products grew by 67% in one quarter. I think that's the area
of tremendous growth. So that's number one. Number two, also the digital economy. That's the focus of the next session, as where Professor Huang he spent a lot of time working on, and then Martin in this institution also spent a lot of time working on. I think right now the digital economy is worth about 7 trillion. You know, it's only ranking after the 7 trillion US dollar. I mean, ranking after the well, this is the broader definition, right? Linked to that. So I still see that as an area of huge potential. That said, I think we have to strike a rather balanced approach, because the traditional sector, the risk sector, they have huge links to the upstream and downstream, and so we cannot just say, okay, now we don't need it, we just go to the new economy. I don't think that's the case. So on that, I think if we can stabilize the real estate sector to 7 to 8% of GDP investment, the share, that would be a good scenario. And then if they, the peak of our housing sales is 1.7 billion square meters per year, we probably now we're coming down gradually, to 1.3 or 1.4. We still undershoot that. I think we have a force to go back to the norm. I mean, of course, the norm is shifting itself because our age, our population dynamics. So overall, I think we have two areas of huge potential: new energy transition, and then the digital economy. But that's something we have to rely on both legs. We cannot totally discard the old or traditional real estate sector.
Thank you very much. As your chief strategist at CIIC, I suppose you're also translating these into investment strategies. Hopefully, we can take some advices from you later. I also have a question for Nick. As you all mentioned about the importance of the private sector in driving Chinese growth, I guess, both in the short and the long run. Last couple of years, we did see the private sector confidence damped by a number of the policy issues during the last couple of years. But now I think from late last year, particularly at the NPC meeting early in March, and the new premier has sent a very strong message that the policies will continue to support the private sector and treat them as the same as the SOEs and so on. My question to Nick is, do you think this would be sufficient to turn around the confidence of in the private sector, or what else would you expect or advise the Chinese government to do in order to fully restore the confidence in that area?
My view basically is that what's been done so far is not sufficient to restore confidence of the private sector, or at least to get it back to playing the role that it did in the first couple of decades or more of reform. And my primary reason for believing that is if you go back and look over the last 10 years, there have been a number of times where the government and the highest political leaders have talked about the importance of the private sector, including Xi Jinping himself. I don't remember exactly when, but about 3 years ago, he had a meeting with the private sector representatives and told them how important they were for China's economic growth, and the lot of verbal support for the private sector. But what happened after that? Private sector investment collapsed. So just because they're talking about the importance of the private sector and claiming that there's going to be a level playing field maybe isn't sufficient to turn things around. What should happen? Well, I'll give you a very simple answer. I think the role of the party in the economy needs to be significantly reduced. If that doesn't happen, I think it's going to be very difficult for the private sector to play the role that it has played, as I said, in the first 2 or 3 decades of reform.
Thank you. My question to Chet, I mean, you described, you explained the situation in the trade sector during the last couple of years, especially on the Phase 1 agreement, the period covered by Phase 1 agreement. One of the questions often coming up in a discussion of the trade relations is the purchase agreement. At the beginning of Phase 1 period, they had an agreement. You just mentioned additional $200 billion US dollars. That was unfortunately not fully fulfilled. And I think we can all see one obvious reason that is COVID. When we were all hit by COVID, it was hard on both sides to fulfill that agreement. My question to you is now, how should we look at that agreement and what should we do for going forward? And some pessimistic people say, well, you didn't fulfill the commitment you made, therefore it's difficult to move further. Some others would argue, well, we actually had real problems we faced and we cannot really change that constraint. What is your assessment and what is your suggestion for the two countries moving forward?
Thank you. I think it's a great question. I think the first thing, obviously, is they need to start talking with each other at the highest levels on trade, and we haven't really begun those conversations yet, at least since the Biden administration has taken over. And a lot of that was there was a lot to deal with the pandemic early on. They had other priorities, and then other things have come up in terms of geopolitics with the Russia-Ukraine war that's made it challenging. So I think firstly they just need to get together and kind of start over. The good news is they're starting from an incredibly low and getting lower base. And so once they do get started on the trade side, things could get better rapidly because things are really quite bad. But it's really hard to say in what direction things should go until they get to the starting point of talking to each other. Now, there were reports yesterday that Ambassador Tai may meet with her counterpart on the sidelines of the APEC meeting at the end of May. And so we'll keep our fingers crossed that can actually happen, and that could be the beginning of something positive.
Can I follow up about a question? As a trade economist, would you recommend or focus on quantitative target like this, the purchase agreement, or would you actually put more emphasis on some of the price measures such as tariffs, trade liberalizations, and so on? What do you think should be the focus if they talk to each other and plan for the next stage?
So I think it's clear that a bilateral approach to those purchase commitments doesn't work. And it not only doesn't work, there's a lot of good reasons, I think, why it didn't particularly work in this, the climate that we had of 2020 and 2021 because of the pandemic.
Yeah.
That being said, a lot of the reasons why it didn't work were not at all related to the pandemic. China didn't buy aircraft, but that was because the Boeing planes had crashed and there were real problems with them and they were grounded. And so they weren't going to be sold even if there wasn't the pandemic.
True.
There was some actually booming trade during the pandemic. So it wasn't all, it was a mixed story. On the purchase commitments broadly, the main reason why they don't work bilaterally is because the rest of the world gets very, very worried that this is just some side deal between the United States and China. And if it actually does work out, it's going to come at their expense. So I think perhaps somewhat controversially, purchase agreements could work or could play a role for a very state-oriented economy like China, but only if they're done in a multilateral sense, not in a bilateral sense, where it would be China sort of making commitments with the world and not just singly with the United States.
Thank you. Let me now call for questions from the floor. Anybody want to ask our speakers question? Who want to come to the mic? Oh, yes, of course, Nick.
I want to ask a question to Dr. Gao, especially the analysis of the property sector and the comparison of sales versus new starts or new construction. And I think you indicated that that was kind of a negative factor, at least that was my understanding. But is there possibly another interpretation that if sales are high but new starts are low, doesn't that mean that a lot of projects that were underway but not completed, there's a big backlog, maybe that backlog is getting reduced, the ones that haven't been finished? And I would have thought, if that's true, or possibly true, wouldn't that be a positive sign? We'd be getting, part of the getting onto a more sustainable path would be getting rid of this huge overhang of property projects that were started at some time in the past but haven't been finished.
Yes, that's a very good point. Actually, there could be two interpretations. The first interpretation is that the developers are under very severe liquidity constraint, so they can't start new projects. And the second one is that they are willing to. They are not willing to start so many new projects because the stockpile is there is too many stockpiles. And the problem for me, I think the key interpretation is that that's because of liquidity constraint, because we can also observe the constraints from the bond market, from the stock market, from the credit market, and so on. And another key message is that actually we have calculated the stockpile held by those developers, and the stockpile is very, very low. It's much below its historical normal level.
Thank you.
Yeah, okay. Tianlei.
Yes, I'm Tianlei Huang. I'm a research fellow here at the Peterson Institute. This is perhaps a question for Dr. Gao Shanwen. You talked a lot about the property sector, how it has been recovering lately. If I can invite you to look beyond the short term, in the long term, what you think the Chinese government should do to prevent such kind of boom-bust cycle in housing from happening again? And we know that the Chinese leadership has talked a lot about this so-called long-term mechanism in housing, 房地产长效机制. Could you talk about what this long-term mechanism is about? Thank you.
Very good questions. And for the first question, I think the key mechanism is leverage. Actually, because in the past, I suppose 5 years, ever since 2016 through 2020, most private developers, if not most developers, at least most private developers compete to increase their leverage dramatically. And then because of the deleverage campaign, the leverage collapsed, and most developers are facing a liquidity crunch. And public developers are doing better not because their leverage is not high, but because they can still steadily collect credit from the banking system. So leverage is a key mechanism that the boost and the bust and the boom cycle could be so dramatic. So actually, that's also the key policy signal from the government that all developers shall reduce their leverage to a more sustainable level, even though the policy implementation process is not so smooth. And I think they may have made some mistakes in the past 2 years. And as for the so-called long-term housing market mechanism, I think the key messages, the key parts could include something like this. First, for megacities. For megacities, the key challenge for the government is that land supply is very strictly controlled. Land supply is very strictly controlled. Therefore, land price continue to go up, which pushed up housing prices. If this policy is not relaxed, then market-oriented mechanism for housing market for megacities cannot work smoothly. Therefore, for megacities, the government will have to intervene to provide low price houses to politically important groups like civil servants, like low paid, low income people, and so on. But for many small and medium-sized cities, the key problem is that people are moving out, are migrating out to big cities. So people are leaving, and there could have been increasing supply glut. And for those cities, I think the key problem is that the market reform shall be further deepened, and so the market can work more smoothly.
Thank you. Martin.
Martin Trozempa, Peterson Institute. I'd like to ask a question which combines the two themes, which is Chad talked a lot about the tariff and trade war, but I'm curious if our Chinese colleagues have done any analysis or seen any analysis in China of the impact of the technology tensions, all of the export controls the U.S. has put on, investment restrictions, potentially future also and restrictions on U.S. investment into China. Have you seen any impact of those restrictions on China's economy, on China's technological innovation and upgrading? There's been speculation, for example, that with the restrictions on building advanced semiconductors, China might massively subsidize production of trailing edge semiconductors, and even if it's not profitable. But then there's some debate here about whether China has the money to do that, because there was an announcement of large subsidies in this space, but then that was drawn back. So I'm curious of how you see the economic impact and China's economic response to the technology tensions. Thank you.
Who wants to volunteer? Yan Liang first.
I mean, I have to admit, I haven't done a thorough study on this specific area of technology, what's the word, decoupling and its impact on the Chinese economy. I do, however, I mean, Martin, you were here 2 months ago. I gave a presentation of, I call it the trade finance disconnect, where I think China and the U.S. Still do a lot of trade. As Chad just shown, in absolute amount, it already exceeded historical peak. However, on financial flows, particularly on equity flows, I see a decoupling, namely US, UK, some of the European countries, Germany, France, and even including some of the Asian economies, South Korea and Japan. They have basically, sold their Chinese equity holdings and then moved to invest in the US equities. Traditionally, we believe that trade flows and the financial flows should go hand in hand together because they're complementary to each other. Now the question is, we see this disconnect. We still do trade with each other, but we just financially, we transact much less with each other. Then the question is, what happens next? I mean, there are two scenarios. One is financial flows could reconnect with trade flows. Then the implicit assumption is that maybe financial flows just overreact to China-US tensions. And then also the US equity valuation is a bit too high. and then maybe there's value to from a diversification point of view to invest in Chinese equities or related product. So that's one possibility. There's equally another possibility, which is trade flow just react slowly, similarly to FDI flow, to some of other more, investment or fiscal investment oriented flows, and then equity flow or other financial flows. They are the so-called, uh, more fiscal or smarter money. They can just move around on a click in the keyboard. So then I think that would be a much dire scenario that, we will see a really a decoupling world. I mean, I'm glad to see two speeches from U.S. policymakers that we are seeking not decoupling, but in a way, I mean, de-risk. I hope that can be a managed and smooth transition. I'm sorry, it's not a direct answer to your question on technology and its impact on U.S. China on Chinese economy, but more along these lines, I see financial decoupling kind of already happened before things get even worse last year and this year. Yeah.
Maybe I would just add one point. I think we saw preliminary evidence that innovation, especially in the frontier technological area, is slowing down during the last couple of years. And I think this should be expected. If you look at Michael Porter's analytical framework of the so-called national innovative capability, that is determined on the one hand, your input into research and development, but on the other hand, there is also a list of factors which determines your R&D efficiency or productivity, intellectual property rights protection, the openness of your country, and the importance of the public research institutions. Plus, finally, a very important role played by the private sector. That obviously is also the case in China. About more than 70% of the patents are contributed by the private sector. So all these, I think, will be very important. Now, the factor just mentioned the openness of the country, which really just, I think, points to the importance of exchange, ideas, research, collaboration with other countries. That is a very important part of your innovative capability. If the U.S. continues to implement even what Yan Liang said, this is a more a cautious approach, no decoupling, but de-risking. But the key really is about small yards and high fences. And unfortunately, these are all about high-tech sectors. So I think it should be expected that the pace of innovation would probably slow in China. And I suspect it would also affect the pace of innovation in the US, maybe to less extent, but I think this is just something we should expect. So in that regard, there are lots of things, given that this is probably not going to change in the near term. There are lots of things the government can do. Keep open the country, which is very important, but also probably provide direct support to public institutions, research and development, including some of the fundings. I think it will be very important. But also, I think critically, this relates to the private sector we talked about. The private sector investment, the confidence is very important. But as I said, the private sector is really the main driver of innovation. So I think that policy would also be very important. That's my 2 cents.
From the viewpoint of the stock market, actually some strategists have proposed so-called technological self-reliance investment theme, which could contribute to a portfolio composed of mainly technological self-reliance companies. Because of the US government policy, And if we look into the performance of this portfolio, I shall say that investors are still quite hopeful. However, so far the performance is not that good. The valuation is high, suggesting that the investors are hopeful that because of state subsidy, because of the efforts made by private entrepreneurs, in the long run, we may achieve some good results. But the performance so far, the financial results so far is not that good.
Okay. Next question, please.
Good morning. My name is Yeling Tan. I'm a non-resident senior fellow here at the Institute. So Nick, you mentioned the role of the party. I would also like to bring in the role of security concerns, so sort of building on Martin's question there. We see security concerns growing in both the US and China. Within China, we've seen security concerns become more pronounced in high-level Chinese policies. In the 14th Five-Year Plan, there was emphasis on coordinating security and development concerns. At the 20th Party Congress, there was a lot of mentions of various types of security concerns: economic security, energy security, ideological security, system security, and so on. So how do you think firms in the Chinese economy are navigating these high-level signals of needing to take into account security concerns? How is this playing out from firm perspectives? Is this something that creates uncertainty only in the short term? So as things become clearer, right, the private sector will figure out how to navigate these uncertainties, and the vibrancy and the innovation will come back? Or do you think there will be more long-term structural changes in the economy? Thank you.
Oh, Nick, please.
Yeah, well, I don't have an answer to that question. I'm not sure how these security concerns play into the decision-making of private entrepreneurs. I would guess that the vast majority of private companies are in spaces that have nothing to do with security concerns. So it must be a subset, presumably a fairly small subset of companies that would be primarily concerned about this new emphasis on security. So how much of that explains the decline or the collapse of private investment we've been talking about? I don't know the answer, but I would have thought empirically it's pretty small.
I think that's a very, very, very important question, and a very, very good question. Actually, I think ever since 2021, the policy framework in China has changed, possibly quite significantly, because security concerns dominate policy agenda. And security concerns even dominate economic development concerns. And I have shared some graphs which illustrate that for the service sector, the share of private sector in fixed asset investment ever since 2021 dropped significantly. That can be attributed to security concerns. Or put it in some other ways, the crackdown for after-school tutoring, the crackdown for platform, and also the crackdown for property sector could all be attributed to security concerns. However, we can also see a rising share of private sector in manufacturing fixed asset investment, particularly dominated by EV, by solar panel, by batteries, because for those industries which may contribute or promote national security, instead of reducing the security concerns, security. things for the state. So it's a very, very important question. And I think there are two key messages here. The first message is that a given specific private entrepreneur has to think if its business model, if its product is promoting or reducing the national security or security concerns. If it's reducing, if it's helping the government, then it can be encouraged, or at least it can be tolerated. But in any sense, if it may heighten the security concern, then they will have to rethink how to adapt to the new environment. And the second point is that even though here in the United States, national security concerns is also a very top concern, top policy priority, the definition of security differs significantly between China and the US. Because I think the key concern of all those different kinds of securities, the key concern, the key security concern is the party itself. Is that the party stands above everything, the power cannot be challenged in any ways by anyone. That's the key message, which differs systematically from the definition of the United States.
Sorry, how does the property sector being attributed to security?
The first one is someone argue that it's a big bubble. Someone argue it's a big. If it's a big bubble, then the burst of the bubble ultimately will damage financial stability and also therefore security concerns. And
that's financial security, right?
And the second concern is that because the prices continue to go up, and many people cannot afford to buy houses, particularly young people, which create social stability concerns.
That's right. Okay, the next question, please.
Hi, my name is Hiroaki Baba, Senior Representative from JBIC. And my question is about the impact of demographics on the long-term growth prospect. And Chinese population starts to decline, and the share of aged population will continue to rise in the coming decades. And is it possible for Chinese economy to keep the current growth rate in the coming decades? And the other thing, what was striking to me was how sharp the private investment decline was, while state sector keeps the investment level. And is it because, is there any force within the state sector that wants to keep high investment in order to keep the growth rate? Thank you.
Okay, two questions. Who would like to respond? Demographic and private sector investment.
Let me just say a couple things on the private investment. We do have some limited information on the structure of private investment, how much is in housing, how much is in various other components. I think there's been a collapse in private investment just virtually across the board. The growth last year was less than 1% compared to 10% for state investment. And in the first quarter of this year, it was still less than 1%. So I believe it's likely that we've seen an across-the-board reduction in the growth of private investment. It's not limited to property, although I need to look more at the data that Dr. Gao has on services versus manufacturing.
I say a few words on the population demographics, because 2 years ago, I and Nicole also, we translated a book called The Big Demographic Turnaround, written by Charles Goodhart. That book went viral in China. I sold 100,000 copies in China. I mean, that says you how, I mean, this issue, of course, is a big concern. But in doing, in trusting the book, we had a conversation with Charles. The point we laid out is that, look, demographic, of course, is a very big input into the development process. But we think, there's many other factors much more important than demographics. Particularly it's technology, right? In the book he says, we have a declining aging demographic, so inflation is going up. But then we know from history that the population has actually risen a lot, and then we didn't have a inflation problem, majorly because technology advancement. So I think it's an important element, but technology advancement and reform is much more important.
Yeah, do you want, no? Okay, well, we probably will make this the last question, please.
All right, I'm Scott Schmidt at the U.S. Department of Commerce. First, when we're talking about real estate, how much is there a wealth effect in terms of, okay, my condo or my second investment home the price has gone down. Am I really going to buy an EV in the future if my greatest asset, its price is lower? And second, related to that, how much of these real estate investment is actually satisfying homeowner need, or in other words, is a lot of this speculative investment? But my main question is more toward Nick. When we're looking at state-owned enterprises and the party, you look at 3 times as much investment, I think, versus 300 trillion versus 100 trillion, I think something like that in investment. And they used to talk about China as a non-market economy and reducing the size of the state-owned enterprises. What's the chance of that actually happening? And especially given, I'm guessing, I'm not a China expert, but I'm guessing that a lot of these state-owned enterprises are not very transparent. I'm guessing a lot of them that have no ties to real estate, they actually invested a lot in real estate, and now with the prices down, they're not going to want to sell, either because they're not going to make money off it, or because it's going to turn out that they weren't very good investors, and that's going to hurt whatever kind of career prospects they have. Thanks. Well, just to clarify on the numbers, the 300 trillion is a stock estimate of the assets that are controlled by state-owned enterprises. The 114 trillion was GDP in the same year. So we're talking, I wasn't talking about investment flows, I was talking about this massive stock of state assets, and I didn't have time to go into it, but state assets have been growing very rapidly, in part from the figures that Dr. Gao showed us. The state investment has been growing fairly rapidly in the last few years. So assets are growing more rapidly than, the state assets are growing more rapidly than GDP, and their productivity is declining. Now, I'm not sure about your hypothesis about declining prices, because in most cities, prices have not been going down as far as I can see. And in fact, in the first quarter of this year, prices in first and second tier cities are going back up. But I think you are pointing to an important problem, and that is a lot of big state companies make investments in unrelated businesses. So they tend to be, they become large conglomerates in, they're chasing after who knows what, not profitability because the returns are low, but they're not very well focused in many cases. So they end up generating fairly low returns. They may be adversely affected if some of their investments don't turn out as expected.
Thank you. Yes.
My first response is that if we are observing a burst of bubble in China's property market, if that's the case, why the stock price of public property developers so divergent from private ones ever since July of 2021? If it's a burst of bubble, will it not hit public developers as well? But the stock prices suggest that the public developers will not be hit at all. So That's quite abnormal. And my second response is that if we observe the price change or price fall compared to the drop in sales volume, we can know that this elasticity this time is very, very small. If it's a burst of bubble, then this elasticity have to be very, very high because people compete to sell their houses. So the price fall will be very high and the sales volume will fall a little bit because nobody buys. But this time, this elasticity is very, very small, suggesting that we are not observing a burst of bubble. We are observing, actually, in my opinion, it's a bank run against property developers because of the very high leverage and because of the mismatch of maturity. We are observing a bank run. And the final run is by retail developers or homeowners or home buyers.
Could that be, I mean, the bubble is really very hot because the leverage is low, the down payment is very high, so people just hold not to sell.
I think there is, generally speaking, overall speaking, there is no bubble.
Okay, I think we'll leave at that very important point. But obviously, it will be tested by future development of the economy and the property sector. Unfortunately, we have to stop here, but please join me in thanking our four speakers for their excellent contribution. Thank you. I think we'll break for a couple of minutes, then we'll start the second session.
to start? Everyone, if we could take our seats, we're going to start the next panel, please. So I'm Martin Trozempa, Senior Fellow at the Peterson Institute. I focus on digital economy, digital currency, and some of those issues. And today, this next panel, I'm very excited about because we have an excellent group of people to talk about digital currencies. And this is an area that's transforming not only economies, but also the daily life in places like China, as I wrote about in my book. It's completely remade the way that average Chinese people go about their lives. At the same time, we've seen a lot of hype cycles in digital currencies, including around Bitcoin and Ethereum, that they were going to transform the world. Turns out that didn't happen. A lot of that's been disappointed. Now, a lot of the excitement globally is around central bank digital currencies, where instead of anonymous, shadowy collectives of people online running digital currencies, it would be a new version of digital money created by central banks. And one of the key questions is this going to be transformative? Is it going to remake daily life? Will it change the way that financial institutions interact with each other on the back end, but not necessarily change something else? Today, we have the perfect panel to discuss this issue because we can attack it from a bunch of different perspectives. So our first speaker is going to be He Dong, who is the Deputy Director of the Monetary Capital Markets Department of the IMF, and a consistently insightful person who also helped me on my book. And he provides leadership for the department's work on central banking, fintech, and global financial stability analysis, and was previously executive director at the Hong Kong Monetary Authority. So he'll be able to provide a perspective of multilateral institution that is not only doing research on these areas, but also advising central banks, hearing what their concerns are, and driving some of the discussion on it. The second, we'll have Jesse McWaters, Senior Vice President for Regulatory Affairs at MasterCard. He leads the global public policy strategy for digital issues and advises the leadership on AI, central bank digital currencies, blockchain, and IoT. So he'll be able to provide both the United States perspective and the perspective of an institution that actually runs payment systems around the world. The third is Huang Yiping, one of my mentors on China issues and one of the most insightful people on China's economy, as you saw in the last section, even when being a moderator. He is the Jingguang Professor of Economics and Deputy Dean of the National School of Development and Director of the Institute of Digital Finance at Peking University. And he was also, for a few years, a member of the Monetary Policy Committee of the People's Bank of China. So he provides not only an interesting academic perspective, but also is very plugged in with the policy community in China, where central bank digital currency is an extremely hot topic, and China's central bank is one of the most advanced in the world, definitely the most advanced of any large economy on this issue. And then we'll conclude with Rasmus Ruffa, who's the representative in Washington, D.C. for the European Central Bank. He's also the ECB observer to the IMF since 2016. He worked at the ECB European Central Bank in Frankfurt before, and now for 23 years, and he was the head of the Monetary Policy Strategy Division, worked on programs for Portugal and Greece in an important time in the Euro crisis, and has a PhD in economics from Indiana University in Bloomington. So that will show that the world is not just the United States and China. There are other interesting points of view from other central banks. So we'll start with He Dong. Thank you.
Thank you very much for that nice introduction. So in my initial intervention today, I will focus on two issues. One is that what's special about central bank digital currency. I think it's important to start from some conceptual discussion so we can have a good common ground of understanding. And secondly, is what we have seen from across the world in terms of central bank digital currency developments. What are the initial lessons we are learning when in our dialogues with the central banks? Now, in terms of the concept of what central bank digital currency is, it's a digital form of central bank liability. So what do we mean by that? We have electronic payments already. What's special about having a digital form of central bank digital currency?
So it's important to start with the idea that in the modern monetary system, we have the central bank liability as the monetary base. That's an important anchor of a modern monetary system. Now, at the moment, we have two forms of central bank money. One is cash, it's the notes and coins we carry for everyday use by individual citizens. And the second form is commercial bank reserves kept with central banks. These are for clearing purposes, for settlement of financial transactions. And that's only accessible to financial institutions. So that's a form of central bank money that's not accessible to individuals. So at the moment, we have cash and reserves, and these are very different forms. Cash is a perfect example of what is tokenization. It is a token. It is a token that can be transferred peer-to-peer individually from person to person. And it has a very nice property that, whenever you use cash, it's settled, it's cleared and settled on the spot simultaneously, right? And there's no need for an infrastructure to back the settlement of cash. The downside of cash is that you and I, when we transact with cash, we have to be on the same spot. So there are limitations of what we can do with it. So typically that means you can only settle with small transactions for cash settlements, right? For reserves, that has the nice property you can settle remotely. You don't have to be on the same spot. It can be very large and it's very secure, but it has to be supported by infrastructure. First of all, there has to be a bookkeeper. That is the central bank. So you settle transactions when an American firm and a Chinese firm, they settle transactions. Ultimately, it's settled on the books of Federal Reserve or the People's Bank of China. So you have to have a bookkeeper that settles the record of transaction. And there has to be a source of truth. Somebody has to be trusted to tell you that is the state of the world after transactions are settled, okay? So central bank digital currency really has the promise that it can combine the properties of cash and the deposits. And we can design central bank digital currencies as a spectrum of cash-like and deposit-like. So digital currencies, central bank digital currency can be settled on the spot, peer-to-peer, but it can also be in the remote way, right? So that opens up a lot of possibilities. So having sort of covered the background of what central bank digital currency is, what promise does it hold in the digital age? In the digital age, central bank digital currency can be both a settlement instrument, but it can also be an infrastructure. It provides an infrastructure that sets the standards for a more decentralized financial system that can build upon a central bank digital currency. So that's really where we are seeing the discussions are going, in the sense that it's not only another payment instrument, another settlement asset, but also it can be thought about as a platform to build financial transactions, to use as the basis for more decentralized financial transactions. So that's the dual nature of a central bank digital currency. It can be a payment instrument, a settlement asset, but also can be a platform or an infrastructure for a more digitalized financial system. Now, that's in terms of the transaction, fundamental sort of concept. But why are central banks interested in this? There are various motivations we are observing from across the world. And one important starting point is really in the digital age, we need to provide a central bank issued instrument, that's really the foundation for monetary policy. At the moment, when we think about, when the Federal Reserve makes interest rate decisions, it gets transmitted to the economy, people take that for granted. But when you think about it, the precondition of central bank currency, like the dollar, having an impact on the economy, fundamentally, that's because all the transactions in the end are settled in the dollar, right? So that's very important. The dollar provides the unit of account of the United States economy, and also it's the final and the safest settlement asset of all the economic transactions of this economy. Without that, monetary policy does not get transmitted to the real economy. Monetary policy will lose effectiveness. So we need to maintain the demand for central bank money in the digital age. That's really a very fundamental reason why central banks are doing this. And there are various other motivations. For example, for financial inclusion in the developing economies, central bank digital currency can provide an instrument that is accessible digitally in economies where digital payments are not that developed. That's an important consideration. But in other economies, in more advanced economies, the central bank digital currency can be a means to provide a discipline for the private payments market to have some competition. So that's another consideration. So that's the first part of my initial intervention. The second part is what we are seeing across the world. Of course, we know there are front runners. We have smaller economies that have actually launched central bank digital currencies. For example, in the Caribbean region, we have the Bahamas, we have the Eastern Caribbean Currency Union, and we have Jamaica. These economies have launched central bank digital currencies for a clear reason. That is, many of these countries have citizens that don't necessarily have access to digital payments, but they are often hit by natural disasters like hurricanes. So cash management is a very costly business. By providing a digital means of currency or payments, that potentially solves some of these problems these economies face. Now, they have launched it. What we have observed, of course, is that the take-up has been somewhat slow, and adoption rates have been slow, partly as a reflection that there have not been concerted efforts to do public campaigns. And these central banks are now working very hard to fix some of these problems. How do we get onboarding of both merchants and customers, individual consumers, to these systems, to central bank digital currencies? So that's something they are working hard. And then across major emerging markets, I think the front runners include Brazil, in China, and India. So these big emerging markets, really, these economies are digitizing very fast. And in Brazil is a very good example of thinking about using central bank digital currency as a platform to build a more decentralized financial system. So we have a lot of inspiration from the DeFi world, but anchored in the central bank provided the unit of account and the means of payment. So that's where Brazil is really a front runner. In China, we know, of course, it's already very digitized payment system. Everybody's very used to Alipay and WeChat Pay. So what is the role of the central bank digital currency? What is the role of the eCNY? eCNY, of course, has been on pilots in 26 cities, and there are millions of digital wallets that have been already opened up. I think the question here, as we have observed, the Central Bank Digital Currency Institute is really doing a lot of experiments on user experience for example, the use of smart contracts to manage financial contracts. That's based on the idea that central bank digital currency can be programmable money. But I think they are also thinking towards the concept of a universal payment instrument. So that's where a lot of experiments are being done. In India, we know India has a very advanced unified payment interface, UPI, in India. Digital payments are prevalent, particularly in the cities, but cash usage is still very high. So I think RBI is thinking very hard, on the idea of a digital rupee. That's really to replicate a lot of the nice features of cash, but in the digital way. So that's India is doing a lot of work. In the advanced economies, I think the Bank of England, ECB, and Riksbank, Swedish Riksbank, these are also front runners. I think the Bank of England in particular published a very interesting consultation report back in February. And there they made a statement, I think that's very important. The Bank of England and the HM Treasury judge it likely that a digital pound will be needed in the future. I think that's a very important statement. And they make the statement based on two considerations. One is, as I explained earlier, they believe that a central bank digital currency provides a very important anchor for monetary and financial stability in the digital age. That's one important reason. And the other one is that they want to use the central bank digital currency as a way to promote competition and innovation. So that's what we are seeing. But having said this, I would say that we are still in the early stage. I think we have to take this effort as a long game. It's not a 2-year or 3-year project. We have to judge the success of these projects with a time horizon like 5 to 10 years, 10 years. But I believe in 10 years' time, when we look back, the payments landscape will have changed quite significantly. And one area where I think we have a lot of gains to make is really cross-border payments. As at the fund, of course, we care a lot about how the international system connects, right? How individual systems are connected together in the international monetary system, how that's going to be affected in the digital age. This is an area where we know there are still a lot of pain points. For example, if a worker from China, since this is a CF40 forum and the Peterson, if a Chinese worker works in South Africa, if he makes a remittance back to China, a $200 remittance, the average cost is 15%. It's 15%. Globally, remittance costs for a $200 remittance is it's just over 6%. But we have corridors that are still 20%, 15%. And according to the United Nations Sustainable Development Goals, the goal is to bring down these costs to 3% by 2030. No corridor should have more than 5%. This is a very demanding goal. How do we get there? So central banks are experimenting with digital currencies, how to connect them through platforms. This is an area under G20, we have a roadmap to enhance cross-border payments. We have to fix some of the market frictions in the existing legacy systems. But we also want to experiment with new means, new platforms, new channels, new rails, and connecting central bank digital currencies is a promising avenue to do that. For example, Project Icebreaker, hosted by the PIIE Innovation Hub Nordic Center, they are experimenting with how to interlink individual CBDC systems. N-Bridge, hosted by the Hong Kong Center of the PIIE Innovation Hub, is experimenting with wholesale CBDC. But in the end, of course, retail transactions can be connected through such a platform as well. So these are all making very good progress. On the technological side, they demonstrated this really can improve efficiency tremendously and can bring cost down. At the moment, they are focusing on fixing policy issues, regulation, because we know regulatory differences are really an important reason behind some of these frictions behind cross-border payments. So let me stop here. I think this is very early stage, but it's an exciting journey. It takes a lot of effort to see results. But I think in 10 years' time, I'm sure there will be important progress made in this field. Thank you.
Thank you for taking us on a tour of the world in relation to central bank digital currencies, a really great overview of the discussion. Thankfully, you did not mention the United States at all yet, or the ECB, so we have complete room to cover those with future speakers. So Jesse, thank you.
Thanks so much, Martin. Delighted to get to be here today. I'm a recovering management consultant, so as part of that process, I decided not to have slides for this particular event, so hopefully you'll bear with me as I take you through some of our thoughts on this. I think perhaps first important to set a little bit of context in terms of how MasterCard is thinking about CBDCs as part of our approach to the broader transformation of the payment industry. We are best known for operating a global credit card and debit card network. But I think it's important to understand that we are expanding well beyond those networks. We operate today over 20 real-time payment systems in economies around the world. And we also are doing a significant amount of experimentation around supporting the deployment of payments use cases on blockchain-based rails, including in crypto asset ecosystems, and in supporting the development of both retail and wholesale CBDC efforts. And ultimately, our vision of the future is one of multi-rail. Effectively, a world in which a wide variety of rails, card, account-to-account, and blockchain or CBDC based, are used to move value, and in which end users, both individuals and corporates, make use of a variety of rails in order to move funds from one point to another, often across borders, as seamlessly and as efficiently as possible. And so with that in mind, we've been very excited to work with central banks around consultation and analysis as they think through their CBDC efforts. Personally, I've had the privilege of talking to well over 60 different central banks on this topic. We're working on piloting, testing, and learning around how CBDCs can be used in a variety of exciting ways. And we're thinking about, in the longer term, how we can play a role in supporting both domestic and international acceptance of CBDC payments at the point of sale, as well as in supporting the security of these CBDC systems in the same way that we work with a variety of domestic payment systems today in order to secure them against a set of global and transnational security and fraud-based threats. But in the interests of having an engaged and an active discourse, what I want to take a little bit of time to talk about today is why I think it is, at least my base case with respect to CBDCs, is that not all nations will have, at the very least, a retail CBDC in the future, nor do I think that they necessarily need to have one. And so I want to throw out a few of the reasons why I don't think that CBDCs will necessarily be adopted in all economies, in the hopes that it'll spur an interesting set of discussions on the back end. I think that this is a really important thing to talk about, because when I have conversations with central bankers, sometimes they have a very, very clear vision of how they want to deploy a CBDC in order to meet their policy goals. My colleagues at the ECB have an extraordinarily clear vision that they have articulated broadly on this. But if I'm very honest, some of the central banks that I talk to are driven by FOMO, a fear of missing out. They see the reports from the BIS and others that 90% of central banks are exploring CBDCs, and they conclude rightly that to not drive exploration and clear thinking on this topic themselves would be remiss. We think it's absolutely essential that all central banks be thinking about the appropriateness of CBDCs. But the way that we often talk about this is that when you think about payment policy, the core should be trying to identify what the right tool for the job is. What is the best tool with which to achieve a set of policy goals, rather than starting with a set of technologies and saying, how can I plug this technology, be it blockchain or CBDC, into my particular economy? And so I think there are a few reasons why a retail CBDC won't be strictly necessary in every economy in the future. And more importantly, why I think that being there first doesn't necessarily convey a clear advantage. Sometimes I hear people talk about standard setting. And I say, well, if you're able to deploy a retail CBDC first, that will either have a regional or a global impact on setting standards. And I don't think that that bears up with the reality of how retail payment systems get deployed. Retail payment systems are highly customized to the economic and financial structure of a given country at the time of deployment, the legal framework that exists around that, and the policy needs based on pre-existing payment systems that are in place. The result is that while we've deployed real-time payment systems in 20 different economies today, the specific deployment of a common technology base ends up looking quite different in those different ecosystems. And so simply by deploying a CBDC, you don't set, I think, a de facto standard. Moreover, particularly with respect to retail CBDCs, simply deploying a CBDC isn't going to be required in order to interoperate on a financial basis with your neighbors. Today, we have funds flowing across borders in both commercial bank money and central bank money, and it'll be absolutely necessary for retail CBDCs to interoperate with a variety of different types of payment systems, as well as a variety of different types of stores of value, both domestically and internationally, in order to ensure that they aren't functioning to trap liquidity, but instead, as Dong-hee talked about, functioning as a way of ensuring that they maintain the role of the central bank money at the core of monetary policy. But the last thing I'll say in terms of why I don't think a CBDC will necessarily be needed in every economy is that I don't believe, based on the arguments that we've heard to date, that central bank digital currencies are necessary or sufficient to ward off the risk of currency substitution by foreign denominated stablecoins or other sources of value. And we can talk about this a little bit more on the panel if there's interest in it. But I think that the initial catalyst for a lot of, though certainly not all, the work that's been done around CBDCs was a concern that large tech deployment of stablecoins could have a deleterious effect on the monetary sovereignty of countries. But I think that the reality is that when you think about the potential driver for that loss of monetary sovereignty, it's either on an individual basis, a desire to flee your home monetary unit, in which case the deployment of that monetary unit in a different flavor, that of the CBDC, won't do anything to address that desire to substitute to a different monetary source, or that the ecosystem in which you are engaging via your engagement in that foreign denominated stablecoin is so desirable that you're willing to endure the challenges that come and the risks that come with monetary substitution, in which case you are effectively asking the central bank to compete directly in terms of user experience and ecosystem engagement with large technology companies, which I think is a significant task to ask of any company, let alone one that has a number of other competing priorities that are certainly not simple, like maintaining effective monetary policy. Further, I think that setting up a payment system, and particularly a retail payment system, may in some jurisdictions prove to be more challenging than was initially envisioned. I think there are a variety of reasons for this. One is that the deployment of a retail CBDC places the central bank in the flow of transactions for individual retail transactions in a way that for most central banks, the exception of a few like India and Brazil, is relatively unprecedented. This comes with new obligations in terms of ensuring that the network is not used to facilitate financial crime. I think that particularly if you're looking to replicate aspects of a cash-based system in which you have a bearer asset that is able to move on a peer-to-peer basis, this introduces significant challenges and is, I think, in many ways contrary to the 30-year tradition that we've had of trying to pull bearer assets out of the financial system. I also think that there are political challenges associated with that, because even if the goal is to allow only legal transactions, determining what constitutes a legal transaction is not always as clear or as simple as we might want it to be, and that can be an area that can become politically fraught. I think we also have seen, and this is, I think, borne out in some of the cases of the original or the early deployments of CBDCs, that developing an acceptance network can be relatively challenging. In order for a payment system to thrive, a variety of different types of participants that include merchants, consumers, and financial institutions need to find it in their interests to continually engage in supporting and refreshing the use of that network. And in order to achieve that requires both a costly undertaking in that some of those participants needed to be incented to participate, but it also requires a challenging balancing of incentives. So, is any of this to say that retail CBDCs shouldn't be pursued, or that they don't have the potential to drive many of the benefits that they could deploy, driving new resilience, new competition, providing a platform for new innovation, as Dong talked about? Absolutely not. Instead, what I think the challenges that I've outlined here reiterates for us is the importance of approaching the question of CBDCs with thoughtfulness and with a deep commitment to public-private partnership. I think that analyzing why a CBDC makes sense in the context of a given economy is essential. I think testing and learning in concert with the private sector is essential. And I think thinking about the end state of production deployment of a CBDC and ensuring that that deployment is one that is vibrant in terms of its incentives for competition and innovation are all essential to the long-term success of central bank digital currencies and ensuring that they meet the specific policy goals of a given economy. And so I'll stop here, but just to say that I think that this is a really exciting conversation, and thank you so much for inviting me to participate today.
Thank you, Jesse. I think if you put these two remarks that we started with together, you see why I find it so fun to research this space, because there are so many different views on it. There's still a lot of debate and still some room for consensus, but you can see just how different these two perspectives are. I want to provide for the people who may not be super expert on this space definitions of two things. One of them is rails. We refer to rails as kind of like the train network of rails that bring train cars from place to place. It's what guides money from one place to the other, and it's kind of a piece of infrastructure and payments. And the second is retail versus wholesale CBDC. Retail is like the transactions that you do every day, swiping your card, paying in cash, whatever, buying things. That's a retail payment. The big banks, when they're transacting that money, bunching that money together from all the retail transactions and maybe some of their own transactions and doing really big movements of money on the balance sheet of the central banks, that's really the wholesale side. And some of the most interesting parts of this space is is there a connection between the retail and wholesale? And these systems look very, very different, have a different set of participants. So with that, we'll move on to Yiping. Thank you.
Thank you, Martin. Well, I'm very glad to join this session. Martin was probably too generous when he introduced me. Martin visited our school in early days, and we were very lucky to have him. And I'm very proud of what you have achieved so far, and I'm sure you will do much, much better in the future. Just a couple of points on the outlook for ECNY. I'm sure you heard about ECNY one way or the other, and I think two things probably stand out when we think about the ECNY, the Chinese CBDC. Number one is PBOC was relatively early in starting the process. They started in 2014, forming a study group and exploring development, research and development. And as Dong mentioned early on, in 2020, they started to do pilots project. And now there are already lots of experiments around the country. And I personally used ECNY. I actually have one digital wallet on my mobile phone. So that's relatively early. The second point is following the categories or classifications we heard earlier on. The ECNY is mainly a retail CBDC, mostly account-based, but you could also have a token-based with a limited amount and so on. But the main purpose of ECNY for the initial stage was really to provide or improve the payment service. It has a former name called the DCEP, Digital Currency Electronic Payment. So you can see the designers of the ECNY initially was really trying to improve the payment service at home. That's in line with the broad perception that most developing countries wanted to develop a CBDC in early stage. And one of the most important motivations was to improve the efficiency and the safety of domestic payment. While many developed countries probably set their eyes on cross-border payment, that, in my view, was really mainly looking at, well, where is your most significant constraint in the current financial system? In most developing countries, payment is really a bigger constraint in many developing countries. The irony in China, I think the difference in China is that, as you probably know, we already have a very well-developed mobile payment services in China. We use them daily. And each of the two mobile payment service providers, WeChat Pay and Alipay, each has around 1 billion users around the country. And so it's already become a part of our life. So really the question now is, many people wonder, why is PBOC still doing this? Well, we don't really have an additional need for this. This is, I think, one of the puzzling questions for many people. And if you look at the pilot project, we started in 2020, and we're still piloting. And then the question is, so when will the PBOC be ready to officially roll it out? Although we're already using it, and there was a news a week ago in one of the local areas, the local government now paying the salaries of government officials and SOE employees all in ECNY. And some people ask me, well, whether that would be a new starting point of using ECNY. But I guess it comes back to the question, why PBOC hasn't really rolled out officially. And my speculation, I think there are two possible reasons. Number one is, if you officially roll out ECNY, you really need lots of people wanting to use it and being able to use it. This is actually a big challenge. If you are familiar with Alipay and WeChat Pay, you probably would know both Ant Group and Tencent spent lots of energy and time and employed lots of people to establish the infrastructure, the system, and then to roll out across the country. What I say is the ecosystem they built around the mobile payment service is very important. It's very sticky. Once you use it, you can use these mobile payment service to organize your lives. That's why you use it every day and many times during a day. Can ECNY build a similar system to have the similar impact? We don't know yet. So at least I think we need to expand the basis that where people can use ECNY. This takes a little bit of time. That's the first possible reason. The second reason is obviously you are building a new system. And I think, you don't need me to tell you, for a monetary system like a digital one, safety, efficiency will be very important. The Chinese system is designed as what we call the two-layers distribution system. The central bank issue ECNY to authorize the institutions. There are 9 of them. And then these 9 authorized institutions would issue ECNY to the public. So 9 organizations developing their own digital currency wallets. And the PBOC should be responsible for the overall system. I guess there could be a potential question, how does PBOC make sure that this system consisting of 9 digital currency wallets operates always smoothly, efficiently, and safely? This is probably the challenge we are facing. The next question, I guess, is then, well, if you face these challenges and if we already have good mobile payment services around the country, what would be the likely future for ECNY in terms of payment? Now, obviously, there could be 2 possible scenarios. One possible scenario, some people say is, well, when ECNY really becomes successful, it will dominate the payment service platform system, and then might replace the existing service providers. PBOC officials mostly would reject that speculation. And personally, I don't think that's necessarily the outcome of the result. You might actually see a parallel system. Then the second possible scenario is that we have mobile payment services like Alipay, WeChat Pay, and then you have a new system that ECNY coexists with the existing ones. Now, don't told me many times before, there could be benefit of a central bank supported payment system, even if it doesn't dominate the entire payment services because it's public, while the other 2 are mainly privately owned. So existence of a publicly supported payment service would be very useful in terms of ensuring some of the public interest and so on. And the other day when we had another discussion with Dong and his team, there was a suggestion of another possible benefit, so-called contestability, because you have a duopoly in the market now. It is good, but potentially there would be a potential risk of monopoly, unfair competition, and so on. So existence of ECNY would certainly reduce that risk. So I think these are all very good, and I think whether it's a scenario 1 or scenario 2, it does suggest that ECNY will be rolled out in the future and can play a positive role. But obviously, I think that the PBOC probably would not stop there. And the domestic mobile payment is probably only one first step. Then what will be the next? There are lots of possibilities. Don also mentioned about the cross-border payment, the M-Bridge project, and so on. So I think PBOC will definitely move on to develop or turn it into, for instance, a wholesale CBDC. That is also very important and will be needed in our system. The second is to support cross-border payment, which is also badly needed, especially the international payment, the cross-border payment is not particularly efficient at the moment, as Dong also mentioned earlier. China is trying very hard to internationalize its currency, and some people suggest that, well, maybe ECNY can help to internationalize its currency. My own view is that whether or not the currency becomes international, it is determined by your policy environment, not by the form of the currency. But also, I think the digital form might be useful in rolling out, in moving cross-border. But really, at the end of the day, I think the question is, do you have the necessary conditions for an international currency? So I think there could be lots of experiments around it, and the digital form might be useful, but at the end of the day, I think it's determined by the policies. Where you have an open financial system, whether you have all the other conditions that is necessary. So this is more for the longer term, but we cannot rule out the possibility of PBOC trying to make a cross-border, use it for cross-border payment. As Dong mentioned, China already participated in mBridge project, and I think technologically that probably is feasible. So the next step, I think, we'll be very much looking forward to see is what exact steps that these two processes becomes combined. The number one is the further development of the digital currency into a wholesale currency and use it for cross-border payment system. And the number two is internationalization of the currency. I will stop here. Thank you very much.
Thanks, Yiping, for that great overview of the concrete ways that ECNY has been rolled out in China and the evolving thinking on that. That's very helpful. Next, we'll finish last but not least with Rasmus, who's already been singled out for compliments on clear thinking on central bank digital currency with his institution, and he's the only one also with slides. So.
Yes, thank you very much. Indeed, it feels a little bit odd to be the only one using slides here. I'm not a recovering management consultant. Forever central banker, I guess that's what we do. We have slides. No, thank you very much for inviting me to also provide a little bit of a European perspective on this discussion. We have done a lot of work, so I wanted to use the introductory remark to talk a little bit about where we stand, motivation for why we think a digital euro might be needed at some point, and where we're going from here, basically. I hope that I can also show a little bit what Jesse mentioned of the thoughtfulness that really we put into this, and also this commitment to private-public cooperation and partnership that we think is important for this project. A lot has been said already about, see where I have to point at. Well, no, that's maybe why nobody uses slides. So let me just clarify a few points. A lot has been said about CBDCs, and I think it was a very good background that we had already. Let me just make very clear and fix terminology a little bit. What we have in mind when we talk about this current project of the digital euro, it's meant to be a digital central bank liability for retail payments and across the entire euro area, which is maybe also something that sets us a little bit apart from some of the other cases, that we are not just a single jurisdiction, but we have 20 countries that use the euro, and we want this to be used across the entire euro area. So it's a retail CBDC that we are talking about here. What are the key features? What we want the digital euro to do is to complement other forms of central bank money that we have already, cash and also central bank deposits. Here comes in then the public-private partnership. We want to use the private sector for the distribution of the digital euro, and then also to allow them to really innovate and use that as a platform for innovation for the digital euro on which they can build. One point when we talk to stakeholders in our surveys and focus groups, one point that is very important for many of them in Europe is privacy. So we heard that very clearly, very loudly, and we plan to really take that seriously. And we as ECB, as Eurosystem, we don't have a strong interest in any of the end user data, and so we will really limit to the largest extent what we have access to, which will be almost nothing. And so respect this fundamental right of privacy. One point maybe also to mention here at this stage already is that the digital euro will never be programmable money. The governing council, the decision-making body of the ECB, the Eurosystem, has made that very clear. We want 1 euro to be 1 euro to be 1 euro, no matter what form this euro takes, to be always exchangeable at par. Once you make it programmable, that might no longer be necessarily be the case. So that is one of the key features that we see. Trying this again. Now the motivation, again, a lot has been said, but maybe just a few points on what is specific and what motivates us to really look into that and consider why a digital euro might be needed at some point. The basic point at the beginning is we want a payment option that would allow anyone, anywhere in the euro area to make a digital payment, which at this point, of course, you have the usual cards with which you can do that. You don't really have a European solution for instant payments that really reaches all of the euro area, all 20 countries. There have been some attempts by the private sector. Even those attempts have been limited to just a few countries, so never really pan-European, pan-euro area reach. This digital euro could provide the possibility to really have something that reaches everyone, everywhere in the euro area. And then again, what was mentioned already also by Dong, the important thing to have a monetary anchor also in the digital sphere. You have cash in the physical sphere, but payments are increasingly, as we all know, going digital. So we want also the same monetary anchor and the trust that this also brings with it, that you can always exchange private money into public money, be it physical, be it then also digital, to underpin the strength of the financial system and trust in the currency. And then importantly, as already mentioned, we see this also then as a European platform on which companies, the private sector, can innovate. And it gives the advantage that you have an innovation and you can immediately scale it to the euro area dimension. So you get a lot of potential return for innovation by having the ability to immediately scale it to the entire euro area. It also gives possibilities for smaller companies that otherwise might not be able to do that, to reach really all of the euro area through the innovation. So we see a big advantage in that as well. And lastly, let me also mention increasing resilience of European payments. You have resilience in the form of disasters in terms of cyber attacks, where resilience would be enhanced, and normally the private sector alone might provide resilience, focusing more on efficiency. So there might be a public policy objective involved here. And of course, you have the issue of strategic autonomy of the whole European payment ecosystem that you could also achieve with a digital euro. Now, where do we stand at the moment, and where did we come from? This is a timeline, and here maybe you see also a little bit the complexity and the thoughtfulness that really goes into the planning of this whole project. It was basically in mid-21 that the decision was made to enter an investigation phase for the digital euro, which then started in October 21, and we're still currently in this investigation phase. We defined some user cases. There are many different use cases, and we prioritized a few of them based on how they could help us achieve the key objectives that we identified, and also whether the market segments are large enough to allow enough of network effects to really develop. Based on that, we then decided on peer-to-peer, on e-commerce, point of sales, and also government payments. That would be the use cases on which we would prioritize initially. And then we went through different interim reports where we reviewed a number of foundational design choices, and they are mentioned here, the different aspects that we looked into. I don't want to get into all of those. If there is interest in the discussion, happy to say a little bit more about those. Maybe I just wanted to highlight two of them. And again, where do I need to point? Doesn't seem to work. One is on how basically we want to do the distribution of the digital euro. And as already said, it will be the private sector involved. What we found the best way to achieve the objectives is to use a scheme approach. That means that we have the private sector do the distribution, but there are certain common rules, standards, and procedures that are defined, and the euro system would play an important role in also, together with all the stakeholders, define those rules, standards, and procedures that ensure that really this experience to end users is the same across the entire euro area. There are other options one could have chosen, like end-to-end, basically provision by the euro system. That would ensure the same, but probably lacks a little bit on the innovation side because the private sector has much less of a role. And then on the other side, you could have a pure issuance model where all we would be doing is to issue the currency and then leave everything else, the distribution and so on, to others, the private sector. Again, that falls short somewhat on the harmonization on really this euro area-wide reach also. So this intermediate solution of a scheme approach seems to hit the sweet spot where you get the benefits of both sides. You get flexibility, you get the freedom for the market to innovate on top of that. And so this is something that we are developing right now. And since it's important for the private sector to know what this scheme will look like, we already started with a rule book development group that was initiated or started in February this year to really come up with a rule book for the scheme, so then also that the private sector knows what they might be dealing with the scheme. The other point I wanted to briefly mention, which is important when you talk about introducing a CBDC, often you have the argument that it might be having undesirable consequences in terms of financial stability, but also in terms of provision of services by financial intermediaries might crowd out deposits. That's often a concern. And for monetary policy as such, also there might be negative side effects. How do you limit that? And I think, or we think that one of the important things is to limit to the extent to which a retail CBDC will be used as a store of value, also an investment asset. And therefore, there are ways to address this and limit to some extent the holdings of people of retail CBDCs. One is to have direct limits on individual holdings. And these could also be holding limits in terms of the speed of transactions that you can do. So because this is not just about tail events of where you have financial stress, but also normal situations. So you might want to avoid also that people quickly move in and out of CBDC in stress situations. This then we think could be accompanied by what we call a waterfall solution to have a smooth payment experience. Otherwise you could have, with these holding limits, you could have that you get or receive digital euro, but you hit this threshold, then either the transaction is rejected or you only get part of it. So this waterfall function would have a smooth interaction between your digital euro wallet or account with a bank account. So whatever goes beyond the threshold would automatically spill over, like in a waterfall, into this commercial bank account. You could then also have reverse waterfalls if you don't have money in your account or wallet, that then it draws immediately from that bank account, which we believe is an important addition to these individual holding limits. Then in addition, one could also use price-based tools to make it very unattractive beyond a certain threshold to hold digital euros. These are all elements we think might be useful, and some of them, many of them will be introduced, included, but the concrete parameterization at this point is not clear and will be decided closer to a potential euro issuance. So where do we go from here? Now we are basically in the process of pulling together all the different considerations that I mentioned before from those 3 interim progress reports, and then having a holistic review of those different elements and come up with a high-level design for a digital euro, which then will be delivered to the decision-making body, the Governing Council, in the autumn of this year. In parallel, what's taking place is also that the legislators will start a process of creating the legal basis in the euro area for introducing a digital euro. The European Commission currently is working on a proposal for a regulation. That regulation will deal with issues like the legal tender status, like obligations in terms of distribution, compensation mechanisms, that you have the degree of privacy, for example, one could consider, and we consider might be useful, lower levels of like reporting requirements, greater privacy for low risk transactions. But those are decisions to be done or taken by legislators. So that process will take some time. What will happen on our side in the autumn of this year, there will be a decision whether to go ahead or whether not to go ahead with the next phase of this process, where then we would be developing and testing concrete technical solutions and business arrangements for a digital euro. And then at the end of this next phase, only then will there be a decision as to whether or not to introduce a digital euro. So no decision has been made at this point. No decision will be made in the autumn. It will only be made at the end of the next phase, and only after this legislative process has been concluded, so that we have a firm basis. So these 2 processes will run in parallel. And as we hear that there are new developments in the legislative process that we might have to incorporate into the design of the digital euro, we have the possibility to do that. But we want to be ready to issue if that decision is made once the legislation is out. And last point, if there will be a digital euro, will only be the first release. And then there might be other releases, additional use cases. The issue of geographic usage, which also will be in the legislation, is also something that then might be taken up in later releases. And let me stop here. Thanks again.
Thank you very much. I'll invite all of us, the panelists for this session, up to the podium, and we'll take, if there are no audience questions, then I have plenty of questions to pepper them with in the coming 15 minutes or so. All right, let's start with Mark.
So my question is for the Chinese participants. The government of China has built up surveillance mechanisms that would make the Stasi envious. Mr. Rufer discussed privacy concerns in his presentation, so I have 2 questions. Number 1, is privacy a concern in China? And number 2, has the People's Bank or the government put in place any policies to deal with privacy concerns in relation to central bank digital currencies?
I don't think there is any specific policy with regard to privacy protection with CBDC, related to CBDC. But China introduced a long list of policies protecting data, privacy, and so on. We start to have this digital economy, but initially there was no policy. So lots of irregular, even illegal behavior. And the government took lots of action, and people found that actually some people argued that degree of protection is probably more strict than in Europe, according to industrial professionals. So they are making efforts trying to improve the protection, but no specific measures for CBDC as I'm aware. I guess the same approach measures would be applicable. But when we think about the privacy protection or data protection relating to CBDC, the starting point is people already using mobile payment. So if data, they provided data already on the system, these are mainly controlled by the private enterprises. And if you use CBDC, these data to some extent will still be seen by the digital wallet, currency wallet developers. But I suppose the PBOC will also see the whole set of data. So then the question is, do you trust the private sector more, or you trust the public sector more? I don't know, but since you're asking this question, I'm just thinking maybe this would be one of the factors determining which will become more dominant in the future as people trying to choose whether I use Alipay or I use ECNY. Maybe that could be a factor behind.
Just one additional thing on that. The PBOC has a tiered set of wallets depending on your level of identification, and the lowest level of wallet only requires you to provide your phone number, which you do have to register under your real name, but they have a set of procedures. Whether you believe that they will stand or not is a question, but that separates, so the PBOC doesn't know who is behind this wallet unless they see it associated with some criminal activity or something else that they view as problematic. Then they would have to ask the telecom company to let them know who that individual is. But those wallets have lower transaction limits than the ones with full KYC.
If I may, Martin, I think if I can just add on this theme of privacy, I do think that there is, in many jurisdictions, also a failure to understand within existing payment systems the way in which payment data is collected, and in many cases, the way in which it is fragmented. I think there is often an imagining of there being sort of a single point where all payments data is collected. If you look at the way in which our card networks operate, and indeed the way in which the vast majority of card and pay-by-account-based systems operate, there is a fragmentation of data that occurs. Your issuer, who sort of holds and issues your payment credentials, has visibility into all of the payments you make, but they don't have visibility into the item level payments being made at the merchant. Your merchant, if you have a loyalty program with them, might have visibility into all of your payments with them, but not the payments that you make with other merchants. And the network sitting in the middle, for the most part, doesn't know who you are, only knows that you are an account number with your issuing institution, and thus sees a whole bunch in terms of the payment flows, but doesn't have a clear understanding of who the payee on the end of the payment is. And so I think it's just important to understand that when we talk about privacy, particularly given that many of the CBDC frameworks that are being developed, and if I'm not mistaken, the digital euro being one of these, are structured around a similar framework in which the network itself is blinded to the specific participants, but wherein the issuer and the acquirer of those transactions all have and need to have pieces of the data in order to facilitate the transaction.
Great. Next audience question.
Yeah, I'm not sure how much we can compare the European system to the Chinese system, but I guess there's a difference between privacy and secrecy. So maybe someone outside the network doesn't have access to your data, but it doesn't mean someone doesn't know who you are. So I wonder if we could talk a little bit about the programmable features of some of these systems and whether it's a threat, whether it's a concern. For example, perhaps even in a finalized system in China, a peer-to-peer exchange, there's no effect on spending, where you spend it, on what you spend it, perhaps. But perhaps at the state sector, where the state is fairly involved in China, whether it's in the loans or your job or you applying to school and you have the social index, is it possible, and I don't know, can you stipulate, okay, this money is for this purpose in this region? For example, if you leave the region, you can't use this money. If you spend it on things outside of housing or food or some other things, it's off limits. And
to extend this example on the edge, I think it's edge, where China is cooperating with a few other countries kind of on a test basis, can you control how your partners spend their money? So if we give a loan to a company in Thailand, can they only buy from a Chinese company or Chinese allied company? I'm not sure. Thank you.
I think that's an Yiping question.
I'm not sure I exactly understand your question, whether it's programmable. But domestically, what you're seeing, and you certainly, if ECNY, if it's account-based, I suppose the PBOC would know where the money is from and where the money is going. In the private sector, we're already seeing lots of benefits. So for instance, Ant Group would use these data to do credit risk assessment and extending loans. That's been very successful. I thought that's a positive. But can you dictate where the money can only go and without going? I think that's beyond the technical aspect of the issue. If you really want to restrict it, and I think theoretically it's possible, but I don't know it would be feasible to do it. Maybe Don has a better idea.
So I think it's important to differentiate between programmable money and programmable payments. Rufus, for example, in the ECB case and the Bank of England, they said at money level, we don't want to make it programmable. That's very clear. But it's possible because in this sort of tier structures, payment service providers can program payments depending on certain conditions, right? So that can be a very useful tool. So I mean, conceptually, money, of course, is universal, and we want to maintain the universality of a settlement asset, and that's unconditional. That's very important. But it doesn't mean at the payment service level, it cannot be programmed in the sense that it's welfare enhancing because you can automate some of the payments, and in the future it can be connected with Internet of Things. The sensors can tell you when you should restock your fridges, and those purchases can be automated, and that's very much invisible, and we can envisage that, and that will be very useful tools, but it does not impinge upon the usefulness of money at the most fundamental level, right?
Yeah, if I may just briefly compliment, thanks for clarifying that, Dong, because this is indeed important. I mean, programmable money, no, but like conditional payments, absolutely. And this is something that we would also expect the private sector to work on. And we would actually also be willing and interested in supporting these kind of efforts, for example, through having some standards in the scheme that I was discussing for conditional payments, if this was requested from also the private sector. And we could also in the back end on the settlement side have certain services like reservation of funding to make this conditional payments easier from the back end side. So indeed, very important to make this distinction between programmable money and like conditional payments.
Well, I have a question for the panel, which is related to something that hasn't been discussed at all, which is where is the United States in the development of central bank digital currencies? Because we've seen China's one of the earliest movers. The US has been very slow, but I believe it was last year, then Vice Chair of the Fed, Lael Brainerd, said, well, if a bunch of other countries have central bank digital currencies, then we need one too, or we'll lose the role of the US dollar internationally. And some of what some of you have said in your initial remarks sort of suggests that that might not necessarily be the case. Jesse said we might not many countries might not need a CBDC. Yiping said that the role of the renminbi going forward isn't going to be based on technical changes, but based on openness of the financial account and all these other things. So I'm wondering if any of you have any sense, is the U.S. sort of, quote, behind if you compare it to other central banks? That's something that many people in Washington worry about. I generally tell them not to be worried about it, but I'd be interested if any of you think I'm wrong.
So I guess I can weigh in here first, and I don't want to suggest that I disagree with Governor Brainerd, and indeed I'm not sure that I agree necessarily with your interpretation that she suggested that we risked falling behind in terms of the role of the dollar. And here I would agree thoroughly with Yiping that I think that reserve status of currencies is entirely dependent on the desirability of that currency. And so I think it is broadly agreed that the desirability of the US dollar as one of a number of reserve assets has to do with the depth and the liquidity of its capital markets, with the rule of law, with the openness of the capital account, and with its existing sort of incumbent effects as an important part of the international monetary system. And I think that the way in which funds are moved domestically within a country to make retail transactions has very little to do with how an Armenian date farmer chooses to settle a trade obligation with an Egyptian manufacturer. Those are simply not really that deeply connected. I do think that there are important dialogues happening today with respect to the future of cross-border payments. The G20 cross-border payment roadmap being an example of that, the work that's being done by the BIS Innovation Hub, thinking about wholesale CBDC interoperability and platforms for common settlement, as well as work being done in and around commercial bank money, such as Project Nexus, thinking about creating interconnection between real-time payment systems. I think these have the potential to be transformative, and it's absolutely essential that the United States think about how it would plug into that infrastructure and how the US dollar would continue to have or be available to play an important role in the context of that infrastructure. But I think that is quite different from the question of how domestic payments operate here. And I think what you have seen in a lot of the dialogue is a view that is similar to a view that has been espoused in Singapore, in Denmark, in Canada, that there is an advanced and highly competitive payment system present in the United States, and that the addition of a retail CBDC into that milieu would not necessarily have a significant impact on the competition or the innovation within the payment system, nor would it necessarily justify the fixed and ongoing variable costs necessary to deploy that. And so I think we are seeing thinking done on this within the context of the Fed and other places, but I think the jury remains out whether or not a retail CBDC is the right tool for the job in the context of the US and many other countries.
Just a couple of points. I think the Federal Reserve is working very actively on certainly on the technical side. So that I don't think they are behind. They are working very diligently on these issues, participating in experiments. So that's one point I think we should acknowledge. The second knowledge is that in terms of the international status of a currency, I fully agree. It's the policy framework, it's the fundamentals that determine. But technology does have a role to play in the sense that the margin, the way we think about network effects, and all this, of course, technology has a role to play. Switching costs in foreign exchange transactions might be reduced because of new technology. And at this stage, I think our understanding is not really that great yet. I think conceptually we need to study these issues more carefully in the sense that whether different platforms to trade currencies would lead to different dynamics in terms of how import and exports are priced, are invoiced, and whether payments would lead to change in the way how reserves are demanded. All this are, in a way, will be interesting to study in the digital age. I think our understanding is not great yet, but fundamentally, I think it's right to say that it's the policy frameworks, it's the fundamentals that they determine. But I think technology also has a role to play here.
Right. So with that, I think we're at the end of time for this session. Thank you all for attending. I learned a lot, and I've been looking at this issue for a long time. So I'm pretty happy with how this panel went, and I hope you all learned a lot as well. And let's enjoy some lunch.